Good morning, it's Jeff Christian from CPM in New York. It's about 11:30 on Friday, the 18th of June. I wanted to talk today about a sensitive market. We'll talk about what caused the price decline this week, where we think the market's going to go going forward, short-term and long-term. We talked a little bit about that last week. And then I have some follow-up clarifications that I want to do. I want to start by talking about an old Taoist tale I read as a young child. And the Taoist tale was about the emperor wanting a really superlative horse. And so somebody said, this guy is the ultimate horse trainer. He understands the pure sense of horses and their qualities, the key qualities. So the emperor hired the fellow to go find a horse. And guy came back and said, I got a horse that's, being brought to your palace. And he says, what is it? He goes, oh, it's a black stallion. It's really great. And then week passes and a brown mare shows up. The emperor is kind of furious. He says, this guy's supposed to be a really great horse trainer, and he didn't get the sex or the color right of the horse. So the emperor gets on the horse, and of course the horse is fabulous. It has incredible stamina, incredible speed, incredible sense of where it is in space, how to turn, how to stop. It is in every way that's important, a superlative horse. And the advisors to the emperor said, you see, this fellow pays attention to what's important and he ignores the superficial parts. What CPM Group does, and I talked about this last week, is we pay attention to what's important in the market versus what's not. I garnered a lot of respect from the promoters of snake oil and conspiracy theories in 2008 when I gave a speech at the IPMI in which I said that conspiracy theories were gigantic, expensive distractions that investors, instead of paying attention to what was important in the market, the essence of how the market works, its ups and downs, they paid attention to these conspiracy theories, to people who were telling them that silver would be $100 within a couple weeks and gold would be $10,000 within 5 years. And they missed opportunities to take profits. So I'll get back to that because, last week I ran through some of our intermediate term recommendations, buy and sell recommendations, and what they meant to investors who would follow that advice. And I had several people who said, clearly some people didn't understand that. And they asked me to go through that. So I will do some follow-ups toward the end of this about CPM Group's recommendation, intermediate term recommendations versus buy and hold strategies. And I'll clarify a couple other points that we've made or haven't made in the past. Right now, though, let's talk about the markets. We saw a tremendous sell-off this week, Wednesday and Thursday. And the interesting and important thing, the first thing that you have to note is the sell-off was in gold, silver, platinum, palladium, copper, and a host of other things. Strangely enough, the stock market fell a couple percentage, not great, but a couple percent. Oil prices held up until today. But the fact that it was broad-based told you there was something else going on. And what was going on was obvious. You had about a 6 basis point uptick in the 10-year Treasury bond. And that was in part in response to the FOMC's comments that by late 2023, they think that interest rates may be higher than they are today. And if you looked at the dot matrix of what the expectations were for more than 24 months from now, they were about 2.5%. Okay, that's very important. First off, it's more than 2 years from now. A lot's going to change between now and late 2023. Some of the things that may develop over the next 2 years may not be on the radar right now for the Fed or for anybody else. In addition to that, even at 2%, 2.5%, you still have negative real interest rates. So the increase that's anticipated in the interest rates by some people in the Fed, about half of them, are a long time from now. They may not actually transpire. And even if they do transpire, you'll still have negative real returns on 10-year treasuries. All of that's important. And we think that what you saw this week was a overreaction to the FOMC statement and the increase. And we should point out that 10-year treasuries dropped back and gave up most of that 6 basis point, 0.06% gain yesterday. So we think that the market's probably overreacted. Now, that said, we've been saying for some time, since last summer actually, that we thought that the price of gold could rise late last year, early this year, come off in the second and third quarters. We've been saying that we thought that the price could fall to $1,800. And we've also been saying that we thought it could fall as low as 1680 or 1720. It did fall to 1680 in March twice. It tested that level and it bounced back up. We were a little bit surprised by the bounce back up, but we were not so surprised by the decline this week. The speed at which it occurred was surprising, but it's not surprising if you take into account the way markets work these days with technical analysis and computer generated buy and sell signals. You've seen the price come down. We may be in the middle of a measured move, and it's going to be very important to watch over the next couple of weeks. You have a combination of factors, which we were talking about last summer, that have come to pass. One is seasonality. Gold and silver prices have seasonal weakness in July and August. And we produced a market commentary that went out to CPM Group's distribution list for market commentaries yesterday called the Summertime Blues. And we included in that market commentary both the gold seasonality chart and the silver seasonality chart to show that. So that's one of those things. Now, silver seasonality gets overridden by current events. So last summer in 2019, you saw other events override the seasonality, and gold and silver prices actually rose in July. And we wouldn't be surprised to see gold and silver prices rise again in July. We wouldn't be surprised to see silver rise in the next week or so as we move toward the first delivery date for the July Comex contract. The roll is proceeding. You've got about 350 million ounces of July open interest that's already rolled into September. You still have about 425 million ounces or so that still has to be rolled over probably in the next 5 to 10 trading days into the beginning of July. But that could push the silver price up a little bit. We're not thinking that it's going to go over 2750 or so in such a roll, and then we think it might come back off. Over the course of July, we think that gold and silver prices might rise again, along the lines of what we saw last year and in 2019, which was with the August Comex gold futures roll, and that's about 38 million ounces the last I looked. That could cause gold and prices to rise, and silver would come along for the ride. Now, if you look at 2019 and 2020, it's very important to see what happened. You had a tremendous amount of bullishness come into the market as the prices rose. The prices rose until the first delivery days, 2 or 3 days into August, and then the prices came off. And they didn't start rising again in 2019. I think it was late November, early December before you start to see the price rise again. So we wouldn't be surprised to see that kind of pattern again. Gold is vulnerable to another spike down to 1680. We'll see over the next few weeks if a measured move pattern starts to form and gold, consolidates around current levels around 1800. It could be vulnerable for another spike down in early July before you saw the price rise. Silver showing a little bit more strength, partly because July is the active contract as opposed to August. Longer term, we do think that the prices will rise. Now, one of the other things that we had pointed out last summer and we reiterated was that at this time, you'd see optimism in the economy. With that, the pandemic would start looking like it was coming under control in the industrialized world, in the United States and Europe and to some extent in China, and that economic activities and optimism toward economic activities would be picking up about this time, and that could weigh on gold and silver for a period of time. And that is exactly what's been happening. We do think that the optimism is partly realistic and based on real developments. And we do think that part of the optimism is maybe a little bit overdone. And we wouldn't be surprised to see in the fourth quarter of this year some dissipation of that optimism and a shift to what we would call a more realistic view. So we're pretty much in line with the price outlooks that we talked about last week. Gold is weaker than we had thought, but not much weaker, and it is there. Now, I wanted to follow up on some of the clarifications there. I showed 4 charts and tables last week with CPM Group's published intermediate term buy and sell recommendations since 1980, when we started keeping records. And you can see, from 1980 to November of 2000, we were basically saying buy and sell we were telling people not to buy gold as an intermediate 1 to 3 year investment horizon until November of 2000. In November of 2000, the arrows are a little bit off on this, it seems. We did issue a buy recommendation. The price was $293, and we kept that until January of 2012. Issued a buy recommendation after that. But the important part is what that means. If you did a buy and hold, if you had bought gold on December 4th, when we started 1980, when we started this, and just held it, the price of gold would be up 182%. You would have increased your gold, the value of your gold holdings that much. And if you had bought and sold and gone short per our things, the price would be up 12,850%. Much bigger returns by trading the reality of the market, having that sense of market saying, this is a good time to buy, this is not a good time to buy, this is a good time to sell. That's important because one of the comments that we got in reaction to this was, well, I'd love to see how your performance stacks up to someone like Peter Schiff or any number of these other people who have been talking about $10,000 gold and $100 or $1,300 or $13,000 silver for one guy in 2015. He said within 5 years, silver would be $13,000 and gold would be $22,000. And I guess he missed the mark, but that's okay because he's missed the mark for the entire career that he's had. And if you look at those guys, it's not that they're getting gold and silver wrong, they're getting the world wrong. Because they're all saying, oh, the world is going to collapse, the dollar is going to collapse, the financial system is going to collapse. And in that environment, silver is going to 100 or 1,000 or 13,000, and gold's going to 10,000 or 22,000. And it's not that they've been wrong on gold and silver, they've been wrong that the world hasn't collapsed. And one of the questions I have is, at what point do you stop listening to people like that? I know when I do, like when they open their mouth. But you have guys who, like, since the late 1960s have been talking about the collapse of Western civilization and the rise in gold and silver prices. And at some point you just sort of say, maybe your model's wrong. But people were saying, well, Jeff, how does this return stack up to them? Well, that's very easy because they were saying buy and hold. So their portfolio was portfolio 1. Their return was 2.7 per annum over the last 40 years. Our return was 12.9% per annum over the last 40 years. This is how we stack up to those guys. And the question is not, how do we stack up? The question is, why are you listening to them as an investor? And then we showed silver. Again, buy and sell for most of the time from 1980 to 2000, 2001. In 2005, I think we issued a buy recommendation when the price got over $500. And it went from there, and even better returns there. And with silver, if you had bought and hold starting in December 1980, your annual rate of return would be 0.25%. That's treasury bills now. for most of that time, you could actually get 6 or 7 or 8% treasuries, but 0.25% return for a buy and hold. It doesn't make sense. I want to talk a little bit about Comex silver inventories and put them in perspective. You know, some people are saying, well, you know, there's been this raid on Comex silver, and we've seen 40 million ounces come out since February of Comex inventories. And they use a chart like this with a scale like of 100 to 160. And sometimes they're so gauche as to put a picture of me with my COVID haircut behind it and make fun of my hair. Silly boys. This is putting that in perspective, going down to 0 on your scale. And all of a sudden you can say, okay, yeah, we've lost 40 million ounces, but we still have 110 million ounces. But put that into even bigger perspective, add in the eligible stocks, and it's not as dramatic. And most of the reductions actually were withdrawals by major bullion banks for delivery to industrial users, as opposed to investors. There was some investors buying and taking delivery and deregistering those stocks and putting them in eligible stocks, but it was not the majority of the 40 million ounces. And even taking that into account, at 110 million ounces, Comex registered stocks are about twice as high as they have ever been. This only goes back to 2003, but you can take this all the way back. You know, I think in our silver yearbook, we have it back to something like 1980 or 1972, if you want to see the data. And we have a table too, so you can play with the data and manipulate it so that you can make your point. But you still have enormously high inventories by historic standards. And if you look at the inventories relative to deliveries, they're still very high. In fact, they're probably greater now, that ratio, than they were in the past. That's pretty much what I wanted to go over. We focus on what's important, not what's superficial. Guys want to make fun of my hair. Well, they can do that. That's so silly. We are looking at what's important. We're not distracting ourselves with how many hits we get on the internet. We're looking at what the returns are for our clients, because that's what's really our measurement of success. We don't look at what's superficial. We look at the real markets. We will be having an open forum next Tuesday for clients. If you are a retail investor and you bought into the retail investor program that we created a few months ago, you are a client and you can participate. It is no formal presentation. It is basically open. Anybody can ask questions, any questions that they want. We have the right to refuse that. Answer questions like, you know, why is your hair so ugly? But we will answer and address relevant questions. In the past, people have asked us, you know, how do mints buy their silver? What's really going on with the mint? What's the stories with the blanking? Unfortunately, and I think I mentioned this a couple weeks ago, what really is happening with the blanking supply is a matter of corporate confidential matters. So we can't talk about certain aspects of what's going on there, but we can talk about what has happened there. And I will say this, some of the commentary that we've seen on the internet is actually wrong. It's great, the suppositions that people come up with, but that's what makes the world go round. You can buy our yearbooks. You can become a retail investor client. You can contact us for a lot of other services that we offer. And if you are a client, we hope to see you or hear you on the open forum next Tuesday. In the meantime, stay good, stay clean, stay safe, be good to yourself and be good to others, and have a good weekend. We'll talk to you next week.